It was October 16th, 2001, a Tuesday morning in Houston. The quarterly earnings call was about to begin. On the call agenda, a routine third quarter announcement, the CFO said, some non recurring charges. The company wanted to provide, in his exact words, transparency. The number he wrote he read was $544 million in losses. The number he did not read, buried in the press release, was $1.2 billion wiped from shareholders' equity. 47 days later, the company would file for bankruptcy. This is the story of how the seventh largest corporation in America became the largest corporate bankruptcy America had ever seen. To understand what collapsed on December 2nd, 2001, you have to go back almost 10 years to a party. The party was held on the 31st floor of a Houston office tower on the night of January 30th, 1992. The host was Kenneth Lay, the founder and chairman of a company called Enron, a Houston natural gas pipeline operator that had been quietly trying to become something else. The man being celebrated was Jeffrey Skilling, a former McKinsey consultant who joined Enron 18 months earlier on one condition. The condition was an accounting method, specifically mark-to-market accounting, the technique used by investment banks to value their trading books. Skilling wanted to apply it to Enron's long-term natural gas contracts. If a 20-year gas supply contract was worth a projected $100 million over its life, Skilling wanted to book the whole projected value as revenue the day the contract was signed. The Securities and Exchange Commission had spent the previous 12 months reviewing the request. On January 30th of 92, it sent Enron a letter saying, in its restrained regulatory way, that it would not object. Lay and Skilling poured champagne. The two of them and the chief accounting officer, Rick Causey, signed the letter and toasted it. A photograph of that signing would later become a fixture in books about what happened next. What had been approved that night was not by itself fraud. It was the architecture of fraud. In the years that followed, Enron stopped being a pipeline company. It became what Skilling called asset-light. It sold off pipelines, power plants, water utilities, and kept the trading desk that bought and sold the commodities those assets produced. By the late 90s, Enron was no longer in the energy business. It was in the energy trading business. By the year 2000, it was running trading desks for natural gas, electricity, weather derivatives, pulp and paper, and broadband internet bandwidth. All of it carried at mark-to-market values that the company itself estimated quarter by quarter. The stock price followed. From the merger price of around $40 in 1990, Enron's stock crossed 60 by 1999 and reached its all-time high on the 23rd of August, 2000, $90.75. At that price, Enron was worth $70 billion. Fortune magazine had named it America's most innovative company 6 years in a row. McKinsey case studies treated it as the model of 21st century corporate strategy. The financial press called Skilling, by then the chief operating officer, soon to be CEO, the smartest guy in any room he entered. But underneath the marks, the actual business was deteriorating. The long-term contracts didn't always work out. The broadband bet was burning cash. The water utility, Azurix, was a disaster. By 1998, Enron had a problem. A growing pile of investments whose mark-to-market value on paper was higher than what they could ever realize in cash. The company's new chief financial officer and 36-year-old named Andrew Fastow had a solution. He proposed a series of off-balance sheet partnerships, limited partnerships that Enron would technically not own but would substantially control. He named them after his wife and sons. L for Leah, J for Jeffrey, M for Matthew. LJM he named the second set after the Velociraptors in Jurassic Park. Enron would sell its underperforming investments to the Raptors at prices well above their realizable value. Enron would book the gain. The Raptors would carry the loss off Enron's books. The collateral for the whole structure was Enron's own stock. Two people outside the company noticed something was wrong. The first was a 30-year-old reporter at Fortune magazine in New York named Bethany McLean. In late January of 2001, she was researching a feature on Enron when she made a mistake. She tried to figure out how Enron actually made its money. The financial statements were over 200 pages long, full of footnotes referring to entities like Chuco, LJM Cayman, Raptors, Enron through IV. McLean could not find the operating cash flow. She could not match the reported earnings to anything that resembled cash coming through the door. She called the company for comment. When Jeffrey Skilling, by then the chief executive officer, got on the phone with her in late February, he listened to her questions for 30 seconds. Then he told her in 3 words that her questions were unethical. And he hung up. McLean's article ran on March 5th. It was titled simply, "Is Enron Overpriced?" The second person who noticed was a short seller in New York named Jim Chanos. Chanos ran a hedge fund called Kynikos, Greek for cynic, that made money only by betting on companies going down. In October of 2000, he had read a small article in the Texas regional edition of the Wall Street Journal about gain on sale accounting at energy traders. He pulled Enron's annual report. Inside, he found footnotes describing related party transactions with entities he could not identify. He read the footnotes 3 times. He told the SEC under oath 2 years later that he could not understand them. He started shorting Enron in November of 2000. The stock was at $60. He kept reading the disclosures, kept adding to the short. For 7 months, nothing happened publicly. Inside the company, the Raptor structures were quietly failing. The marks were too optimistic. The collateral was Enron stock, and Enron stock had peaked in August of 2000 and was no longer rising. By the summer of 2001, the Raptors owed Enron money they could not pay. On August 14th of 2001, Jeffrey Skilling resigned as chief executive officer. He had held the job for 6 months. The official reason was personal. The stock was at $42, less than half its peak. Kenneth Lay took over again. The next day, a vice president of corporate development at Enron named Sharon Watkins sat down and wrote a letter to Lay. Anonymous at first, she wrote that she was incredibly nervous that the company would implode in a wave of accounting scandals. She signed her name a week later. She got a meeting. Lay assured her that everything would be looked into. It would not. The story shows us one thing. This doesn't fix itself. Quick word from the sponsor of this episode, a private space where I go through over 100,000 deep dive courses, including psychology, business strategy, and finance. The kind of depth a Fortune article doesn't have room for. If corporate trust has surprised you, the governance and incentives tracks inside go deeper into why. Link is in the description below. Now, back to October and the quarterly earnings call that started this episode. On October 16th of 2001, Enron held the quarterly earnings call that opens this episode. The $544 million after-tax loss was attributed to non-recurring charges related to certain previously disclosed structured financing arrangements. That was the Raptors. The Securities and Exchange Commission opened an informal inquiry the next day. On October 24th, Andrew Fastow was forced out as CFO. On November 8th, Enron filed restated financials for the previous 4 years, wiping out $613 million in previously reported earnings, increasing liabilities by $628 million, and reducing equity by the $1.2 billion the company had already announced. In the same period, Arthur Andersen, Enron's auditor for 16 years, ordered the destruction of thousands of pages of audit work papers and emails. The lead auditor in the Houston office, a partner named David Duncan, would later admit to ordering the shredding. A Houston rival energy company, Dynegy, briefly tried to acquire Enron, $8 billion in stock, with another $2.5 billion in cash from Chevron Texaco. The deal was announced on November 7th. On the 28th of November, the three major credit rating agencies, Standard & Poor's, Moody's, Fitch, downgraded Enron to junk status. The downgrade triggered cross defaults across Enron's debt and the SPE structures. The same day, Dynegy walked away from the merger. 4 days later, on the 2nd of December, 2001, Enron filed for Chapter 11 bankruptcy in the Southern District of New York. $63.4 billion in assets, the largest corporate bankruptcy in United States history at the time. On the day of the filing, 4,000 of the company's 20,000 employees were laid off. The retirement accounts of those 20,000 employees had been mostly invested in the Enron stock, 62% of the 401k plan's $2.1 billion pool. The matching contributions Enron made to its employees had come in the form of company stock, which they could not sell until age 50. When the stock fell from $90 to 26 cents, an estimated 15,000 of those 20,000 employees watched their retirement savings evaporate. About $1.2 billion in pensions, the figure the United States Senate Committee on Homeland Security would later certify. The day the SEC inquiry began, October 17th, Enron had imposed a 3-week administrative lockdown on the 401k plan that prevented those employees from selling out of the company stock. By the time the lockdown lifted, the stock was below $10. Step back from the people and look at the mechanism. The fraud at Enron was not fundamentally about skilling lying or lay-hiding losses, though both of those things happen. The fraud was about 3 accounting rules that, when combined, produced a system where it was possible to make money look like it existed when it did not. The first rule was mark-to-market accounting on illiquid contracts, which let Enron book the projected value of multi-year deals as current quarter revenue, with the value of the projection set essentially by Enron itself. The second rule was a 3% threshold for special purpose entities, which let Enron move losses and debt to limited partnerships that the company controlled in practice, but did not have to consolidate on its balance sheet. The third rule was the absence of auditor independence. Arthur Andersen earned tens of millions of dollars a year from Enron in consulting fees that depended on Enron remaining a client. Auditing the same client whose consulting business pays your mortgage is not structurally auditing. Bethany McLean asked the question and was called unethical. Jim Chanos read the footnotes and shorted the stock. Sharon Watkins wrote her letter and was thanked for her concern. Skilling and Lay were celebrated by Fortune magazine until the day they were not. The accounting rules made the fraud possible. The incentive structure made it inevitable. The auditor made it invisible. And the ratings agencies, who were paid by Enron to rate Enron's debt, kept the company at investment grade until 5 days before bankruptcy. The smartest guys in the room were the ones who read the footnotes. None of them worked at Enron. 7 months after Enron declared bankruptcy, the United States Congress passed the Sarbanes-Oxley Act. The law restructured corporate auditing in 3 significant ways. It created the Public Company Accounting Oversight Board to police auditors. For the first time, auditors had auditors. It banned audit firms from providing most consulting services to their audit clients, closing the door that Arthur Andersen had walked through for 16 years at Enron. And it required chief executives and chief financial officers to personally certify their financial statements under criminal penalty. In 2006, after a 16-week trial in Houston, Jeffrey Skilling was convicted on 19 counts of fraud, conspiracy, and 1 count of insider trading. He was sentenced to 24 years and 4 months. Kenneth Lay was convicted on all 6 counts brought against him. He died of a heart attack at his vacation home in Colorado 3 months later, before sentencing. A federal judge vacated his conviction posthumously under a doctrine called abatement. Andrew Fastow served his 10-year plea deal sentence, forfeited $23.8 million, and now lectures business schools on what he did. Bethany McLean wrote a book. Jim Chanos kept running his fund for another 22 years. Sharon Watkins became Time Magazine's Person of the Year. The deeper lesson is not that the system is rigged. The deeper lesson is that complexity is opportunity. The longer the footnote, the higher the chance no one is reading it. When the people inside the company are paid to write the footnotes, and the people auditing the footnotes are paid by the people writing them, the system is doing exactly what it was designed to do. It is a night of January 30th, 1992, just for a moment. The 31st floor of the Houston office is full. The chairman is holding a letter from the Securities and Exchange Commission. The chief financial officer is pouring champagne. The man being toasted is the smartest guy in the room. The accounting method they are celebrating is not, by itself, fraud. It is a tool. The next 10 years will turn the tool into a system. The system will produce earnings until the marks stop matching the cash. The cash will run out faster than the marks. And 47 days after the chief financial officer says he wants to provide transparency, the 7th largest corporation in America will be bankrupt. Nobody at the party knows that yet. Subscribe so the next one finds you. Every market has its legends.